Um, and that is the importance of being an equity investor requires that you take a long-term time horizon. Because I know more recently there's been some clients that have been a little anxious about what's going on with the equity portfolios, some of the movements and machinations within particularly the growth side. And I would say that the answer usually is if there's no like in the case of one of the positions that's moved against us here recently is the Morgan Stanley Growth Fund. If it's a high quality team that's executing the same strategy that has made them very successful for the past 20 plus years in the growth side, that usually giving them time to work through the strategy is the right answer. And I think this chart does a great job of explaining why that is, because you can see here over any daily time period. So what you're seeing is from 1926 to 2018, the percent of the time the market was positive, percent of the time the market was negative, and then moving out into a 1 year to 20 year time period, best return, worst return. And so, on a daily basis, the market's it's more or less a coin flip, although biased a little bit to the positive side. So that works in our favor as to, why you would even want to be an equity investor in the first place. If it was percent negative, then that wouldn't be an attractive risk reward. You can see here, as we move out the time horizon, your odds of success or having a positive return, assuming you don't change anything or liquidate or something like that, get exponentially better. So you have roughly a 75% chance of a positive return at a rolling 1 year time frame. And again, this goes back to 1926. So we are pulling in very negative periods for the market, like the 20s, a latter part of the roaring 20s, the recessions of the 1950s and 60s, stagflation in the 70s, the dot-com bubble in 2000, GFC in 2008, and the like. And once you get out to this 1 year period, though, you can see this is why I keep telling clients the 1 year period really isn't even a great window to evaluate whether or not you've had a successful investment performance when you're looking at active strategies, because you can still have these very disparate outcomes on a 1 year time frame. 25% of the time it's going to be negative. When it's negative, it's going to be pretty brutal. On the worst return over this time series was negative 44. Go back to March of 2020, you were at a negative 30. So these things can happen. However, if you just step it out to a 5 year window, your odds of success get far greater. So you're at almost a 88% positive percent rate. Best return is 27.25 over this time frame, rolling 5 years. Worst return collapses to 6.14%, which is really interesting, the difference between those time frames. Rolling 10 year, the picture gets even better with a barely negative return over that 10 year rolling period of negative 2.5. And then what we should all hope to be getting to is in our retirement accounts and equity accounts, rolling 20 year period, 100% chance of a positive return. Best rolling 20 year period is 17%. Worst is positive 5. So this is why it's absolutely critical to maintain that longer term time horizon. And also, I think, trust in the process, because that's when we deviate from process, that tends to be where things go sideways. And we definitely want to make sure that we're not making any changes that because we need to, but because we want to.